Imagine two companies. The first is massive. Factories spread across the globe, fleets of trucks, warehouses full of merchandise, thousands of employees. The second has no factories, no trucks, almost nothing physical you can point to and say, that's theirs. And yet, the second company is worth 10 times more than the first. It sounds like a contradiction, doesn't it? How can a company with nothing be worth so much? The answer lies in something you can't touch, can't hold in your hands, but which can be more valuable than any building or machine: intangible assets. These are the invisible engines that drive a company's value, and that the market often ignores until it is too late. If you learn to identify and analyze them, you can find opportunities most investors will only notice when it's already too expensive to get in. Most investors have been trained, almost conditioned, to look only at what's visible. They look for assets that can be photographed and counted: land, buildings, machines, inventory. And yes, those matter, but in today's world, they are no longer the main thing. 40 years ago, most of a company's value was in its tangible assets. Today, according to studies on the S&P 500, over 90% of the market value of the largest U.S. companies comes from intangible assets. In other words, what creates the most value today is exactly what can't be physically touched. We've entered an age where the invisible is worth more than the visible. Intangible assets are resources that have no physical form, but generate, or can generate, massive economic value. Apple doesn't just sell smartphones, it sells status, style, and trust, which is why millions pay more for an iPhone, even when similar devices cost half the price. Tesla has battery technology, Pfizer has exclusive drug formulas, Google has search algorithms that no competitor can legally copy. Amazon Prime locks customers into an ecosystem where it's more convenient to keep buying there than to look elsewhere. Facebook and Netflix use behavioral data to create personalized experiences that keep users engaged for years. WhatsApp and Airbnb benefit from network effects. The more people use them, the more valuable they become. These assets create competitive moats, barriers that protect the company from competition and secure long-term revenue streams. The reason the market underestimates them is simple. Traditional accounting doesn't fully reflect the value of intangible assets. They often appear undervalued or don't appear on the balance sheet at all. The Coca-Cola brand is estimated at over $80 billion according to brand value rankings. But on the company's balance sheet, it's worth far less. An AI startup might have an algorithm capable of generating billions in the future, yet on paper that asset might be recorded at almost zero, and that opens a huge opportunity for the alert investor. If you can see value where accounting doesn't yet show it, you can buy in before the market catches on. In the early 2000s, Amazon was the butt of jokes. Analysts saw an online bookstore that was losing money, with no major physical assets, competing against retail giants. But a few investors noticed something different: a rapidly growing customer base with extremely high loyalty, a company building its own logistics system powered by software that could scale globally, and a data-driven recommendation engine that could increase sales without increasing marketing costs. These investors weren't buying a bookstore, they were buying an ecosystem of technology, logistics, and data. The result? Those who got in early have seen the stock multiply more than 1,000 times since then. If you want to keep discovering strategies like this, finding where the hidden value lies before the market wakes up, subscribe to Investor School right now. That way, you won't miss a single insight that could change the course of your investments. Knowing intangible assets exist isn't enough. You need to know how to evaluate them. Look beyond the cold numbers and read annual reports, focusing on the management discussion and analysis, the section where companies reveal strategic strengths that don't show up in the financials. Measure customer loyalty by researching retention rates, reviews, and social media mentions. Because a loyal base is an enormous asset, check patents, trademarks, and copyrights that can secure a competitive edge for decades. Identify network effects, where a product becomes more valuable as more people use it. Assess switching costs. If it's expensive or inconvenient for customers to leave, the company has strong retention power. The most frequent mistakes investors make are ignoring intangibles completely because they're hard to measure, overestimating companies purely on brand hype without checking if there's real substance underneath, and focusing only on immediate profit while missing assets that mature over the long term. The key is to find companies with strong intangibles and business models capable of monetizing them sustainably. We are in the era of companies that are light in physical assets and heavy in invisible value. Uber doesn't own its fleet, Airbnb doesn't own hotels, and yet both have been worth more than global networks with massive physical infrastructure. The next generation of market leaders will be built on data, artificial intelligence, digital communities, and exclusive intellectual property. Those who identify this early will be in position to capture the biggest gains. The point isn't whether intangible assets will continue to dominate. It's when you'll start recognizing them before the crowd. The greatest investment opportunities are almost never obvious. They are hidden, disguised, waiting for the trained eye of someone who knows where to look. And now, you know exactly where to start.